Oh, damn it, Janet. No sooner have the markets decided there would be no interest rate hike from the US Federal Reserve this year, or the Bank of England for that matter, after a very dovish commentary from Chairwoman Janet Yellen, than a gaggle of officials from the US Central Bank have popped up to say that the next increase in American headline borrowing costs could come very soon, in fact as early as June or July. This leaves investors once more in the steely grip of central bankers and pondering what the latest policy decisions could mean for portfolios. So in this edition of our regular markets review, Breaking the Mould, we're going to look at whether a rate rise really is imminent in the US or the UK, and how stock markets have responded during prior hiking cycles. Hello, I'm Russ Mould, AJ Bell's Investment Director, and let's start with whether the Fed may indeed be about to raise rates. Janet Yellen and her colleagues seem to be focusing on three factors when they make their decision. First, US unemployment. The headline rate has rattled down to 5% from its 2009 peak of 10%, but the labour participation rate shown here is down to barely 63%, a multi-decade low. It's therefore possible to argue the US jobs market is not as strong as it seems, with lots of new posts coming from part-time or low-paid service jobs. Second, the headline consumer price index is a key feature, and it's showing year-on-year inflation of just 1.1%, well below the Fed's target of 2%. But the core inflation rate, which oddly enough excludes food, energy and a lot of other things relevant to everyday life, has been at around that 2% mark for 6 months. So this indicator suggests there is scope for a hike. Third, financial markets, well, they're currently a bit calmer. The Fed's backed off from rate hikes before after share and bond price tantrums, so this indicator, well, frankly, it could go either way. Investors, besides those three key things, might also like to consider soggy purchasing managers indices, sentiment surveys, particularly in manufacturing, and also inventories, wholesale and for business, which stand at historically uncomfortable levels. Any cuts in production to control those levels of unsold stock could further hurt already soft manufacturing output data. So the case for a rate rise is a nuanced one, I would suggest, and the US bond market, for its part, doesn't seem particularly convinced. The US 10-year Treasury yield barely flickered after all this hawkish talk from the Fed officials, rising by just 11 basis points to 1.88% before easing back again. Still, the bond market could be wrong, so it's worth looking at prior US and UK interest rate cycles to see what happened, just in case, even if the past is no guarantee for the future. So since 1970, US interest rates have moved lower 8 times and higher 7 times. Stocks have undeniably done better on average when rates have been falling, not rising. The average gain from first rate cut to last is 19.8% in the S&P 500, while the average gain from first hike to last is 10.3%. The rate cycle trends are pretty similar in the UK, although the market isn't pricing in the first move here under Bank of England Governor Mark Carney till 2018. Again, in the UK, stocks have historically done better during down cycles for interest rates rather than up cycles since 1970, as shown by the FTSE All Share. So ultimately, investors have two options when it comes to central bank meetings. First, ignore them. You can adopt the line followed by legendary investor Warren Buffett and argue that economics and policy, unforecastable. The Berkshire Hathaway boss suggests you are better off focusing instead on individual stocks to try and identify those whose competitive position may have the pricing power that turns into predictable cash flows and dividend growth over the very long term. Or you can look for funds that do the same thing. Second, you can pay attention. Interest rates and interest rate expectations are an important part of equity valuations, especially for discounted cash flow calculations. So you may want to get a feel for rates now, as well as how they may change and how quickly in the future. Again, you will choose which path works best for you, but whatever your preference, central banks are not going to go away in a hurry. Thank you for watching, and I look forward to seeing you next time.